We are on session number 7, which is our first of our managerial accounting sessions. For the next 3 to 4 weeks, we'll be concentrating on managerial, which is from an internal perspective, as opposed to financial accounting, which looks to external users. The comic strip here is that because a large font makes profits look bigger, if only it were that easy to make profits bigger. In this particular session, we're going to cover 2 modules, modules 16 and 17. 16 is what we call CVP, or cost volume profit, otherwise more affectionately known as break-even analysis. And then module 7 deals with relevant costs and frameworks for making decisions using economic analysis. But before we jump into the nitty-gritty of managerial accounting, I thought I'd summarize the differences between financial and managerial. Let's look at financial and managerial accounting side by side for comparison. First, regarding the purpose of the two, financial accounting is an information processing system in order for us to generate reporting that is useful to both insiders and outsiders, whereas managerial accounting has a very specific purpose for supporting the company goals, namely the managers and other users internal to the company. The level of detail is pretty low for financial accounting. It can be aggregated all the way up to something like total revenues or total selling, general, and administrative costs. Whereas if you're making decisions as a department manager or as an executive, you need far more detailed information. We'll see line items for each of the line managers up the chain of command. So appropriate to what his or her responsibilities are, they will receive a monthly report showing the financial effects of their decisions. Third are users. For financial accounting, both internal and external. For managerial, however, it's for internal. One large group that does a lot of work in this field is a department called FP&A. It stands for Financial Planning and Analysis. And this is like the analytical arm for the CFO, as well as the general managers of the company. Also, those who are involved in the pricing or strategic decisions for the company will need this information, as will production, because they're managing costs and production in very specific details. The timing is, when do we need the reports? For financial, it is not that timely. We could get annual reports that are months after the end of the year. We can get quarterly reports, again, weeks after the end of the quarter. However, for managerial, you need information much more quickly. It could be monthly at kind of the longest, and perhaps even weekly or daily for certain critical functions. As far as evaluation, do you focus on the past or future? In financial accounting, the perspective is definitely in the past because we take very few risks and make forward-looking statements. However, for managerial accounting, we need the facts as far as what has occurred, but our goal is to look forward and make decisions that affect our futures. And standards for financial accounting, we know it's GAAP, as promulgated by the Financial Accounting Standards Board and also by the SEC. And then for managerial accounting, there's no external standards per se. There are industry groups and professional organizations, but it's not like a set of imposed rules. Companies use their own approaches and policies to generate information most useful for their decision. Again, since there is no external audience, it is strictly what is in the best interest of the company and its managers. And measurement in terms, is it financial or non-financial? For financial accounting, it's primarily money. It's dollars if it's a U.S. company. Whereas when we look at managerial accounting, it certainly would look at financial measures, but also non-financial measures and strategic measures, such as time and quality, dimensions of output, or customer relationships. There are pretty big differences, but summarizing it in one simple phrase, financial is for external users, managerial is for internal users. That's kind of it. Let's look at module 15, which is CVP, cost volume profit, analysis and planning. There are 5 learning objectives in this module. One is looking at the assumptions and purposes of CVP. Second is looking at the organization of a functional income statement versus a contribution income statement. For GAAP, we were focused primarily on function, such as SG&A or cost of goods sold. However, when we're running the company, we need different kinds of information depending on the cost behavior. And we'll get into that one. Learning objective 3, we're going to jump into how to do the CVP for break-even and scenarios in profit planning. And learning objective 4 is looking at what would happen if you have multiple products. Break-even is usually done for one product. It's fairly straightforward, but most companies have more than one product. So we'll do an illustration of one way to simplify that task short of massive computer programming. And LO5 is looking at a measure called degree of operating leverage. which helps us to assess profit opportunities and the risk of loss. Let's jump into traditional CVP. We're looking at three main areas: the revenues of a company, the cost of the company, and the resultant profits. And the costs are further broken into variable and fixed costs. And those are the specific behaviors that I was referring to. And we use it a lot for looking at existing businesses, but also when we're contemplating entering a new business or entering a new product line. We're trying to see, what is our break-even point? How many must we sell just to make the whole thing pay for itself? That's what break-even is. We typically do these as one of the last steps before approving a particular decision or a new product launch. What would we use to do this profitability analysis? We look at selling prices and behavior of the costs and its drivers. We're going to look at two different perspectives. One is if you're a for-profit company, and the other is you're a not-for-profit company. For-profit is pretty obvious what we want to do. If we're Starbucks, we want to know how many cappuccinos do we have to sell to earn a profit of $50,000. If we're McDonald's, we may want to look at what is the break-even point. How many hamburgers or French fries do we need to sell to break even in a particular store? If we're Office Max, what is the profit if we reach 200 million? Or if we're Disney, what would happen if ticket prices were to go up by 10% and if fixed costs were increasing by 8%? These are all sample questions that you can imagine are pretty basic and questions that are asked pretty frequently. And CVP is the tool that we use to analyze and make recommendations. As far as not-for-profit corporations, just because they're not making profit doesn't mean they don't care about the behavior of their costs and what generates an excess of revenues over costs or a deficit. It is used for specific things like service levels that you would do to serve your community or your target audience. Or if you're running a fundraising event, how many tickets do you have to sell to your gala in order to make it profitable? And third is estimate the funding requirements to support an operation for a given period of time. And questions specifically might be for a homeless center house, how many people can be served by a budget of $400,000? So we have to know our cost and our staffing levels required to serve people in our community. And secondly, as an example, how much would we need to raise from alumni from Princeton to provide 50 full scholarships? That's an easier one, but it's nonetheless something that is done all the time in institution of higher ed. Some assumptions are made in CVP which make the math easy. If we look at very complex cost behavior patterns which are nonlinear, it gets much more complicated, again necessitating computer modeling or higher orders of math. First, we say costs can be broken into either one or the other category, fixed or variable. Fixed do not change regardless of how much volume you have in your business. Variable, on the other hand, changes. For every unit that you sell, there's a direct variable cost that goes up, and it's linear. It's the same amount for every unit from the first unit to the 1,000th unit. Second, the costs are linear, as we mentioned, but more practically speaking, over a relevant range. So it may be that there's costs that ramp up in the beginning, then it stabilizes, and then costs ramp up again when we hit diminishing returns. We assume that during the relevant range being defined as the range of outcomes we're considering, not too small, not too large, it's in a certain range. That's called the relevant range. It's where decisions lie. Third is total revenue is also linear, that there is a price, and that price is paid by everyone, again, from the first widget sold to the millionth widget sold. The fourth assumption is that we're looking at a single product, and therefore we can look at specific margins on one product. However, we can do a simplifying assumption for multiple products, which we'll do later on in this module. Fifth, there is only one activity cost driver. In this case, it's the unit sold. So often costs may not behave with units sold. There may be other factors done that cause behavior of costs, such as weather, right? Weather, especially in extreme climate areas, would drive the heating, ventilating, and air conditioning costs, as opposed to how many widgets you made in your factory. But we're going to ignore all of those and assume that it's either fixed, or if it's variable, it's all moving based on units sold. These are very broad assumptions, but with these we can find some very simple calculations in order to accomplish CVP and its objectives.